Tax video 1B, Deferred Tax Assets and Stock Appreciation Rights. This is Ken Boyd, the owner of St. Louis Test Preparation. Here's our Facebook page, the email, and the website, and we now are on Twitter at St. Louis Test Prep without the quotes. And finally, the book Cost Accounting for Dummies will be out in March 2013, and you can go to the website to find out about our free ongoing course. This is kind of a complex issue because it combines deferred tax assets and liabilities with stock appreciation rights. So, to sort of set the stage, remember that deferred tax activity occurs when book or accounting income, which you pull from your accounting software, differs from the income on your taxable return, or your tax return, which is your taxable income. And we are talking about temporary differences in particular. So now that we've laid the groundwork there, let's talk about stock appreciation rights, or SARs. What are they? Well, the purpose is to reward valuable employees for long-term increases in the company's stock price. It's a long-term reward. How do we do that? The employee receives something. They receive the difference between the fair market value of the stock at a point in time and the price on the grant date, the date that they are granted these SARs that we'll find out about in a minute. When do they earn the money, the reward? After a vesting period, and specifically, vesting means certain service time with the company. In my example, it's going to be over a 3-year period. We sometimes refer to these as golden handcuffs because it motivates an employee to stay at the company. Vesting means the percentage of some benefit that the employee owns, the percentage of some benefit that the employee owns. So, let's go on and talk about how does this create a situation where you have a deferred tax asset. Well, obviously that SARs is going to be exercised sometime in the future. So we have future compensation expense as a company when an employee exercises the SARs, and we have to pay them the difference between the fair market value and the price on the grant date. So we have more expense and less income, and since we have less income, we have less tax in future years. And the big kicker here for SARs is that none of this deferred compensation expense is deductible until the SARs are exercised. We're going to find out that these SARs are not going to be exercised until pretty far into the future. So here's a timeline as to what's happening with this question. On 11x1, make it easy, the SARs are granted to an employee. The price on the date of the grant of those shares is $20 a share, and that one stock appreciation right allows that employee to buy one share of stock, so it's a one-to-one relationship, keeping it simple, and that the total rights granted are 1,000 shares, and we're going to say employees, it's amongst different employees, and you'll see why in a minute. So 1,000 rights means 1,000 shares. 12/31/X1, 1 year later, the fair market value of the stock is increased to $30 a share. We'll say that the tax rate is 30%. And then we assume in our example that 3 years later, after 11/X1, at 12/31/X3, the SARs are fully vested. And the rights that vest, 90% of those shares vested, which means 10% do not vest. And if they don't vest, that means that the employees have left the company before the 3-year requirement was fulfilled. And then on 11/X4, all SARs vested or exercised the day after they all vest. And the fair market value on that day is $40. It's the same fair value as 12/31/X3. We'll assume that the price on the exercise date, 11/X4, is no different from the value on 12/31/X3 when everybody's shares vest. And the question is, What should be reported as a deferred tax asset at 12/31/X1? Now there's an assumption that we will have future tax income to use the deferred tax asset. We're going to make that assumption. So it's a two-step process. We calculate the value of the SARS on 12/31/X1. So the total SARs are 1,000. The value of each SAR is the fair market value on the date at 12/31/X1 less the value on the grant date. So fair market value of the stock 12/31/X1 30 in blue, value on the grant date 20 in green, 1/1/X1 when we granted those rights. 90% of the people vest, 10% leave. So if I multiply A times B times C, that's the value of the SARs at 12/31/X1, which is a future compensation I've got to pay. Now it's a deferred tax asset again because the deferred compensation isn't deductible until the SARs are exercised some date into the future, which in this case is 1/1/X4. So if I take the value of all the SARs on 12/31/X1, which is 9,000, calculated here, and I multiply it times the X1 tax rate, 30%, I get a deferred tax asset of $2,700 because I'm going to have a future expense which will reduce my taxable income because I'll have less income on my tax return. So what we just found out is that stock appreciation rights reward employees for long-term increases in the stock price. We see a calculation of the increase in the stock price that they get as a benefit. It's earned over a vesting period. It creates a deferred tax asset because we'll owe compensation expense in the future and we'll have less tax in the future. And we calculate that as the shares, it's one right per share, times the value, the dollar value of the increase in the fair value since the grant date of $10 a share, the percentage of the shares we expect to vest, in this case 90%, and we take that total of 9,000 and we multiply it times the tax rate of 30%, and we get our deferred tax asset. That's the end of Tax 1B. For video textbooks, additional videos and spreadsheets, some are which on YouTube and some are not, you can go to the website. We now have a new website where all of our YouTube channel videos are grouped by category on the website, which makes it easier for people to search for videos, including this one. We'll add this one. Live one-on-one tutoring and chat sessions, stltest.net is the website. And finally, again, the book Cost Accounting for Dummies will be out March of 2013, and I teach a free ongoing class online on the book. Thanks very much. We'll see you next time.